Senior U.S. economist Thomas Simons and MagnetInvesting Insights founder Jordan Kimmel. Gentlemen, thanks for joining me on set today.
Great to be with you.
Okay,
Likewise, yeah.
So, Thomas, I want to start with you. Let's, talk about the PCE market lowered that chance of a 50 basis rate cut down to 30.5%, right? So, kind of what was your read on that, and where do you think things are going when we come to that September meeting?
Yeah, sure. So this morning, I actually thought that it was going to come in even a little bit lower than it did.
Okay.
We were looking for 1/10 increases month on month. At this point in the cycle, those little details are what everybody's trading on. The number of times I've been asked about forecasts out to 2 and 3 decimal points when most people know how unreliable economic forecasting is in general is just kind of astounding. So I do think that it opens the door for them to ease. I am not really in the 50 basis point, cut camp, so to speak. And it really, I think, kind of breaks down to what we see in the jobs numbers on Friday, this coming Friday. And I think the bar is very, very high in terms of having to demonstrate a significant weakness in the economy that just doesn't seem to be enough evidence of that to expect it.
Yeah, I think we're at the end of August, and I think back to a month ago, everyone was going crazy. It was like, oh my God, emergency rate cut.
Yeah.
We need to do something now. But it does, seem like we're going to get that rate cut in September. So Jordan, I want to bring you in here because who stands to benefit from this rate cut? We are seeing that rotation trade start to come in, some of the small caps. I think a lot of our viewers are sort of sitting in those money markets and they're thinking, okay, well, if we're going to get a rate cut, where should I be putting? Is small caps attractive to you right now?
Well, small caps actually have better value, but you can't say small caps because I'm more granular. I dig deep.
I love that. Tell me where then.
So my model really looks for revenue growth. It looks for margin acceleration. Clearly, there's a little benefit for home builders and, for the interest rate cut. And the other bigger part, though, people felt really great at 5%. They hadn't gotten 5% in the money market for a long time. So much money that's waiting to kind of come out or it's going to be pushed out and forced out again. So, I'm a stock picker. I don't really buy indexes or ETFs. So I brought some of my best picks. And again, it's all a matter of revenue growth, margin acceleration, and institutional accumulation. What I like to buy is what the institutions are nibbling at, and they get behind me, and we run it.
Yeah, well, no, I love that granular piece because it is true, right? You just hear small caps, and you really do need to kind of look into the financial health of the company, what's going to stand to benefit in a rate cut environment. We are seeing this rate of inflation come down. That was certainly emphasized in what we saw today. But I'm going to be honest with you guys, prices aren't coming down. Because I got a Starbucks today, a nice latte for $7. That is not coming down. I regretted it immediately when I left there. But all to say, wage growth, real wage growth isn't keeping up with that, or it's not rising quickly enough in order to make those prices feel more manageable. So Thomas, I read your note, and consumer confidence is just soaring right now. So kind of help me understand why people are still feeling it, but they're saying, oh yeah, I feel good about the future.
There are a couple of things I think that feed into the consumer confidence rebound. One of them, believe it or not, is the switching at the top of the Democratic ticket. Is that confidence, especially as it was measured in the University of Michigan survey in July, took a really big hit. And they break it out between Republicans and Democrats. And you see the Democrats' expectations for the future had just collapsed, right?
Sure.
Now it's back. But, to your point, the rate of inflation, the increase in prices has slowed dramatically, but price levels are still very significantly higher than they were in, say, 2019, right? And I do think that a lot of consumers are hopeful that prices of certain things will go back down to some level that's consistent with where it was before the pandemic. But I think it's similar what's going on in the consumer side is what's going on in the corporate side, which is that businesses adapt to a higher interest rate environment. Consumers had to adapt to a higher inflation environment, and, life goes on, right? So on the margin, it's not the most, positive dynamic. It's not, the strongest, motivator of growth going forward.
But you adapt. I think that makes a lot of sense. And, Jordan, just before we go, I want to ask you about, okay, if I'm thinking about the rest of the year, sort of rationalizing my portfolio. I think you had a great analogy. It's that cleaning, right?
Right.
How do I sort of pick out the ones that need to go away? So just quickly, what do you look for in a healthy company?
Okay, what you look for is higher bottoms and higher tops, and you look for volume coming in on the upside, and you really like low volume drawdowns because it's not real selling.
Okay.
It's really just dribbling out, and so it's very important that the trend is correct, and there's great companies that will go sideways or negative for years. So what Magnet does, it brings together both fundamentals and technicals. We only want to buy companies that are going up. There's an old guy, Will Rogers, the old horse guy.
Yeah.
He said, I only buy stocks that go up.
I love
and when
that.
they stop going up, I get off.
And, and those fundamentals, because I think we've seen a lot of valuations out of control. It's really important to bring it back to that. Gentlemen, have a great holiday weekend. We'll have to leave you here.
You do
You
the
too.
same.
Appreciate it.